Last week we spoke about the chaos that the government has brought down on itself by forcing contractors working for HMRC to go on the payroll. This week we're going to look at another area heavily influenced by policy, namely company cars. When it comes to cars used in a business, there are some options, but it's largely governed by whether the car is provided by an employer, typically a company, or whether it's privately owned. I've had a number of questions recently about the tax advantages of company cars, so I'm going to give you an example of how the benefit regime can work in your favour. But first, let's have a brief recap of the essential rules of the car benefit scheme. In most cases, the taxable benefit is calculated using the list price of the car when new, and a percentage based on its published CO2 emissions. A lesson here is don't buy an old Merc with a big engine. The benefit is based on the new price, not what it's currently worth. There's an additional benefit if you're also provided with fuel, and bear in mind that motorhomes and Land Rover Discoveries, however adapted, are cars for these purposes. So what is so special about low emission cars, and what are they? At the moment, a low-emission car is one with emissions below 75 grams per kilometre, but that's going to go down to 50 grams per kilometre shortly. Obviously, a purely electric car has no emissions and so qualifies. Now, you might be forgiven for thinking that the benefit on which you're going to be taxed should be based on the costs of providing the car. But no, this is where policy comes in. The government wants us to drive greener cars, hence the link of the benefit to CO2 emissions. If the employee makes a contribution to the acquisition cost, this is taken off the list price and reduces the benefit. The benefit charge covers all running costs except for a chauffeur and fuel. The benefit is reduced if, for whatever reason, the car is not available to the employee for a part of the year, or they can make a contribution themselves towards the running costs. Here is an extract of the current table, starting at 7% and going up to 37% of the list price of the car. The 37% is obviously for that muscle car of yours on the forecourt, and at 37% you'll have paid tax on the whole price of the car within 3 years. Diesel cars get a 3% supplement. I've missed out most of the rates, I've just given you the ones at the top and the bottom. There are some notable exceptions, and you can use these to plan your benefits. If you are supplied with a vintage car, that's one more than 15 years old and worth more than £15,000, the benefit is on the market value and not on the list price. Other exceptions are cars where there's no published CO2 emissions, whether that's imports or self-builds or whatever it is, or disabled cars. What about employers? The big bonus here is that for low-emission cars, the employer can get 100% first-year allowance, provided that the car is new. Obviously, there are alternatives to a company car. You could use your own car and charge the company a mileage. The mileage charge is tax deductible in the company and tax-free for you, which is a bonus. If you have the choice of being employed or self-employed, the more relaxed car regime might make being self-employed more attractive, so it could come into the equation of how you negotiate your contract. If you're provided with fuel, there is a benefit. And here you multiply the same CO2 percentage that we were speaking about previously by a figure which the government publishes each year, currently £22,200. There's a big difference between cars and fuel here. The car benefit can be reduced by a contribution to the running costs. Fuel benefit is an all or nothing. Either you pay the full cost of the private motoring or there is a full benefit. You cannot pay a proportion. So now we come to a planning idea. Here's the story. Daughter going to uni. Parents are 40% taxpayers running their own company. They buy her a low emission car costing £9,500. I think the story is a daughter here because a son probably wouldn't want to drive a car like this. The daughter is not employed. The car is provided by the company to a member of a director's household, and so the benefit is charged on them. The benefit is just 7% times £9,500 or £665. At 40%, the tax payable by the parent is just £266, and the company pays Class 1A national insurance of £92. Compare this to the tax that would be borne if the parent took out additional salary or even dividend to pay for the car. In addition, the company may get 100% first-year allowances on the cost of the car, tax relief on all running costs, plus claiming back VAT on these costs, but of course not on the car itself. For a while now, we've been telling people not to have a car in their company because of the benefits in kind. Now there are certain scenarios when putting a car through the company has serious tax benefits. If you think this is something which you want to explore, please get in touch. I'm Alan Long from the Long Partnership, making life less taxing.